All right, everybody, welcome back. Let's go ahead and get started. A little bit of a turbulent day in the market, huh? Indexes are down pretty heavily. S&P dropped by like 2.5%. Our Nasdaq was down like 3%. Dow was down about 1.75%. Turns out Trump wants to do more China tariffs again. So that conversation is back, sort of the same thing. China tariffs. Yeah, so same sort of thing that happened in April. We're kind of feeling that volatility again. It's possible we could have another correction like that, but you know, who knows whether he's going to actually implement things. He likes to talk a really big game ahead of time and then things tend to fall off. That's kind of like that taco trade that people were talking about, where he would talk about all these things that he wants to do, and then you basically buy into the dip and it goes, well, since he is not going to commit to anything, it'll come back. So I'm curious how that's going to play out. That'll be kind of interesting going into today because we're going to talk about actually building a portfolio with a lot of the stuff that we learned last week and the week before that. So we're going to actually build a sample portfolio with real holdings. I want to make sure it's abundantly clear, again, like last time. I'm not recommending each individual security that we're using here. None of these are going to be perfect for your needs. They're just meant to be an example of what we're looking at. So first, let's go ahead and, well, actually, first, before anything, today's Friday Forum will be at Mendocino Hall 1005, like they have been. Looks like we got an artist today. But let's recap what we talked about last week. Last week, we went through sort of the examples of what sort of things are going to fit into each stage. So we started with talking, just again, going over examples of what each of these stages are going to be representing. So you might have distributions, withdrawals from an account. You might have upcoming expenses that you're going to pay. You might have just a volatility buffer. If you don't like a lot of volatility, you can really extend this sort of immediate term, short term, just kind of interest earning position and really have much less volatility in the market because you squish down the other two. Your short to midterm needs in your stage two, it's going to be mostly income generation is kind of the idea of how I'm picking stuff. Things that are moderate volatility. So we're not looking for S&P or NASDAQ sort of swings up and down like we saw today. We would hope to be sort of, 50, 60% of that volatility rather than, taking on all of that, because we're going to have that for our long-term appreciation needs to offset inflation, if we're going to self-insure long-term care, and that's a little bit ways away, or just other long-term goal funding, whatever you have that's just several years out in the future where we can recover from a strong correction or even a bit of a recession. So we talked about some examples of things that could go in there. So stage one, we might be thinking about treasury bills or money market funds or super short-term, high-grade corporate debt, things that are maturities of less than 3 years pretty much every time. For the stage one, generally, I'm actually going to use stuff that's even shorter in duration because I don't really want to have much fluctuation when it comes to interest rates changing, but I am willing to stretch a little bit when it comes to the sort of like back end of that stage. So I want to use money markets and treasury bills to keep that really low volatility, but I'm willing to add in a little bit of short-term high grade, so high credit rating corporate debt. So we'll get into the details of these a little bit later in the class, but in stage two, we're talking about maybe longer term debts or index funds or balanced index funds. Maybe we're talking about value funds, short to intermediate term government bonds. So maybe we're giving a little bit more of that interest rate volatility. Now just be careful when you start stretching out the duration of funds, because when it comes to, I was just looking at some longer term ETFs on my analysis software, and the 10 to 20 year bond funds or the 20 plus year bond funds still down 30% in the last 5 years. So that total return is really important. Yes.
This is a question for Zoom. I know you're going to talk about this later, but do you have anything general to say about what type of return can you expect from each of the stages?
So that kind of depends, again, on what's going to compose each of them. For the first stage, I would be expecting maybe like 3 to 5% over, and it really just depends on what interest rates are doing, right? So if we have interest rates that are down at the floor, we can't expect, positions that are pretty much reliant on interest rates to give us like 5% returns. It's still going to be kind of whatever the interest rate is out there. But in sort of the intermediate needs, I mean, maybe between like a 5 or 6% return-ish. Again, it depends what you're putting in there, and it depends on the context of when you're invested in things. So like value and dividend stocks, you might get some of that 5 to 7 or 8% returns, but intermediate term government bonds, depending on when you bought in, like I was just talking about, you could only be getting a couple percent or even losing. So it's really hard to say what the returns are, but I mean, I guess if you wanted to really try and put numbers to it, probably 0 to 5% in stage one, anywhere between 4 and 8% in stage two, and then just anything that's above that, sort of in the double-digit range, is going to be in stage three. So over stage three, again, that's sort of our stock indices, growth funds. If we've got individual stock holdings, this is where I want to hold those. Super concentrated sector funds like technology and healthcare, things that are a little bit more speculative or sort of sensitive to what's going on. So you could see today that consumer staples are doing sort of all right. They're holding their ground, but consumer discretionary was hurt pretty bad, because that's going to include things like technology and other things that people spend on when they have extra money. So kind of like understanding the difference of those sectors can also be helpful. This is also where we include those longer term bonds, because as I was talking about, those longer term bond funds are still hurting pretty bad. Like they still haven't quite recovered from the interest rate changes that happened. We talked about vertical integration, where we start with our sort of inexpensive, broad exposure funds, and then we start getting a little bit more specific as we get up here. Sort of, I like to call level two where we do our tilt. So if you have like a total market US stock index fund, but you like value stocks, this might be where you start to get some of those. So you still participate in the overall economy, but you can play towards your preferences. And then you might include some managed funds up at the top just to give you a little bit of that diversification. Again, level one being achieving the stage's objective at a low cost. So we don't want to be paying a whole lot of fees just for broad stock exposure. It just doesn't really make any sense, especially when, again, 89.5% of large cap funds underperformed the S&P 500. Like that's 9 out of 10, right? So if you want to try and be the person who can pick 1 out of 10 funds that then pick the stocks that perform well, go ahead and take that chance. But I would prefer to play for the numbers and the statistics and just allow the stock index funds to do the work for me. Maybe if I want to take a chance on that level 3, that's okay. But I want to make sure that the bulk of my portfolio is statistically probable in making it happen. We're not taking chances. I want to make sure that we're realistic. We're just seeking broad market exposure with these holdings. Just like John Bogle said, founder of Vanguard, don't look for the needle in the haystack, just buy the haystack. And because of how these funds are constructed, because of market cap weighting, oftentimes you'll have bigger allocations to the winners. And it just kind of is a self-fulfilling prophecy that it will generally work out in the long term. Again, we're strong emphasis on the low cost. We're willing to pay for a value. So for example, if we really want to make sure that we're not spitting out any capital gains or anything like that, I might be willing to pay for a tax managed fund, but I'm not going to pay for somebody to do a growth fund where the statistics say that 9 out of 10 of them are not going to perform the same. It's just not a valuable trade-off for me. And level 2, we're generating exposure to some more targeted investments, whether it's equities or bonds. Again, this is kind of where I talk about, this is where we apply our tilt. So if you like being a value investor, if you like being a tech investor, if you like being a defensive investor, whatever it is, this is where I would start to kind of apply those beliefs and those systems that you might want to use on your portfolio. As we move to the top, this is where we're going to do one of two things generally. For the most part, what I'm going to do is pick from a management team that has a good track record. So I'm going to allow them to do some work for me, and hopefully they are actually able to pay off and give me better returns for the level of risk that I'm taking. Or if, especially in stage 3, when we're taking our highest amount of risk, I might take a little bit higher risk than I would in stage 1, where I get nice diversified exposure. But then as we get to the top, I might go, okay, well, I really believe in, I think energy is going to do something crazy. And then I might put an energy allocation at the top, but it's still small, so it's not affecting my portfolio that much. Yes.
When you showed us last week, How you would go on and look at managers and see how long
Yeah.
they've been there. When you last week went on and showed us how you looked at the managers, looked at
Yeah.
how long they'd been
Mhm.
there, et cetera. In this kind of work, are people generally hired on contracts, like that they come in for 5 years? So that's a standard, or is it like any other employment? In other words, would you ever see where three different people had only been there for a year each? Would that be alarming, or is that the way they work?
Yeah, so I'm not sure about the first part of that question. Do you have any insight on that?
The managers are brought in on contracts, and you want to have at least one of them.
If you would.
The managers are usually brought in on a contract for a minimum of years, and you want to make sure that one of them has been there at least 3 to 5 years, unless it's a simple fund. If it's an index fund or something very basic, then they're just filling gaps with particular positions. But if it's managed and it does something a little bit different than the market, you're betting on management, then you definitely want to have somebody that has 5 or plus years. Some people have been there as long as 15 years, and as well, take a look at how much money they have personally invested in the fund themselves.
Yeah, that's a really good point, is to kind of see how much they believe in what they're doing. It's like how much of their capital is actually invested into their fund. Now, obviously, if they're a super young investor and they're managing a bond portfolio and their wealth isn't completely in a bond portfolio, I can kind of understand that. But at the same time, you want to see some belief in what they're doing. And like you mentioned, you do want to see some experience in there. So if I'm looking at a fund and I go, this has done so great in all of these previous market cycles, and then I see that the managers that are doing it right now have only been around since, and they haven't even experienced a downturn like a strong 20, even a 2020, 2022, or 2008 or anything like that. If they haven't been through that with the fund, how do I know that any of that previous performance is going to carry through with them? So it is important to see that and just kind of like understand how long those managers have been there. And we do want a few years of experience. So we at least know what they have managed this fund through and how they have performed in regards to the other categories. So we're willing to pay higher fees for particular strategies or management teams. So if there's some, bond fund that does just incredibly well and they charge, 0.8%, but they outperform every category year over year forever, like I'm okay to pay that fee because I'm actually getting something for it. Or if there's less downside, if the maximum drawdown is not as much, like it all really depends. I just want to know what my value is. I don't want to just throw money at fees just because I think that higher fee funds are going to do better. We keep the allocation small, so if they underperform by a lot, the overall impact is relatively minimal. But if they succeed, maybe we do get a little bit of a boost. But again, when I'm building portfolios, I'm not building portfolios that are created to return the most. I'm creating a portfolio that's supposed to have the best chance at succeeding at whatever the goal was. So if I'm trying to get to a certain level of assets or I'm trying to provide a certain level of income, it's more about in how many scenarios is this portfolio going to continue to succeed rather than how can I get the highest level of return possible? Because if that's what you're trying to do, then you're going to have a lot of time on your side, pick the best stocks possible, or just have a really good market cycle. So again, I just kind of like to always just throw in these little charts of just like super long-term performance just so that we can see how things are relatively. Like this little dip right here, like it looks like it's absolutely nothing on this chart. But when we experienced that, that was like 30% stock and bond market declines. So it's important to just kind of have all of that in context and understand how each of this fits in and just understanding that if you have the time, stick with it. If you don't have the time, then obviously that's not the right investment. So it's just kind of making sure you understand your risk profile and what comes along with it. So today we're going to talk about two things. Well, first we're going to build a sample portfolio. So I'm going to put together a portfolio today, and then we're going to look at it through my sort of portfolio analysis and research tool that I use called Y charts. For your own uses, I generally recommend Morningstar because it's much more cost effective. Morningstar Investor is a relatively okay cost, and you can get it inexpensively through library cards, which is really cool. So if we still have that resource, we're going to email that out. There's a way. Was it $40 a year? Is that how much? Yeah, it was something like $40 a year for a library card that happened to include Morningstar Investor for free. So we found that resource and that was pretty great. So if you want the most cost effective, that's probably how I would go. I use Y charts just because I like how much I can move things around. I can dig really deep into stuff. I just find it to be a great platform, but it's very expensive for a retail investor. So just keep these sort of visuals in mind as we go forward and we build the portfolios. Because basically what we're going to do is we're going to pick one security for each of these just to kind of show how it's going to be built. You could use more holdings, you could use less holdings. It really kind of depends, and I'll show how that could work as we move forward. So again, we're just kind of splitting these up. So you're going to have your biggest allocations here at the base with the low cost. And as we move up to the higher cost or more specific exposure, that gets smaller. So we're going to begin with a 3-fund portfolio. Each fund is going to correspond to a stage of lateral integration, and then we'll use vertical integration to start diversifying or sort of crafting each stage a little bit further. So if you're fond of the sort of boglehead portfolio building concept, you'd probably stop at the first level because you just build your 3-fund portfolio, super low cost, good to go. Nothing wrong with that. I just like having a little bit more control over my holdings. I like to be able to tilt in certain directions depending on what I'm looking for. So we'll start with a $100,000 balanced portfolio. I always use balance as sort of the place to start because it gives us an opportunity to look at both the more volatile growth assets, the risk on assets, and the sort of more stable risk off assets. It gives us an opportunity to look at both. So the overall asset allocation will be approximately 60 stocks and 40 bonds, be roughly in that area. It might be a little bit different than that once we actually look at the charts. But we're going to assume that the investor has a little bit of current cash needs. Again, think of like somebody who's taking RMDs right now, or is just taking a little bit of income every single year, and they expect to have some long-term growth. So maybe if we just want to make this portfolio last as long as we can, but we do have some current needs that we have to pay for. So we're balancing between those two. So we'll start with these 3 funds here. First is going to be SGOV, and then next is VBIAX, and then next is VOO. The first of those is a fund from iShares. It's a 0 to 3 month treasury bond ETF. If you're familiar with looking up stuff like this is probably a pretty common pick that you'll see because it's paid pretty good dividend yields. The expense ratio is very low, 0.09%. The dividend yield might have changed. I think I had this accurate the last time I edited it, but it might have changed a little bit since I did these slides because we got a rate cut in the meantime. So understand that these things are due to change. But one of the things that I'll point you to is this standard deviation right here for the last 3 years is 0.23%. So it hasn't gone very much of anywhere. It's just kind of stayed in the same place, paid a nice little bit of interest, and the effective duration, or essentially how long the bonds are in there, is about 1/10 of a year. So it's really short. So what they're doing is they're going to essentially go out and look at treasury bills, treasury bonds, treasury notes, and then again, they're going to buy the ones that have 0 to 3 months left. And then they're just going to write it out until the expiration, and they just keep rolling over. So if you like buying individual treasury bills, but you don't like having to remember to go back and buy another one and buy another one, funds like this are super useful because the cost is like basically nothing, and it allows you to just keep rolling into those treasury bills. Now, understand that when rates fall, the rates of this are going to fall just like a money market account or a high yield savings account or anything like that. It's not going to hold these rates for very long. That's due to it being 0 to 3 months left on the bond because it's just they're going to renew and they're going to be buying bonds at the market interest rate, which could drop to 3 or 2 or even 1%, like we saw a little while ago. In the middle, for stage 2, we have this Vanguard Balance Index Fund. This one's pretty cool because it's a 60-40 portfolio wrapped up into a mutual fund where essentially what it does is it tracks 2 different indexes at the same time. just a stock index for 60% and a bond index at 40%. And they only charge 0.07% expense ratio. Funds like this are good for that sort of stage 2 allocation because again, they're low cost still, but they're giving you that broad diversification of total stock market indices and bond indices and stuff like that. And you can see the standard deviation here is quite a bit higher than the previous holding at about 10.73%. So within any 3-year period, well, actually, within any 1-year period, we expect it to sort of deviate between its returns by about either 10% to the upside or 10% to the downside. So if we were expecting this to return 7% for the year, we could reasonably expect in like 65% of scenarios for it to return up to 17 or down to like -3. So that's kind of what that standard deviation is. It's just sort of that band of returns that we're expecting. The effective duration on this is decently higher, and that's because of it using index funds for the bond allocations. Because when you look at bond indexes, this is kind of that average number that you're going to get to because you have those super short-term treasury bills like in SGOV, and then you've got 10 to 20 year and 20 year plus, 30 year plus bonds all wrapped up into the same allocation. So you're getting a little bit of all of that. Last time that I looked, this had a dividend yield of about 2%, which is all right. We can get a little bit better than that, but it's a decent amount of dividend yield, and this gives us a nice moderate amount of volatility so that we're not flying too far up and down. Now at the end in stage 3, this is probably a fund that a lot of you have seen, might have, ticker VOO. It's a S&P 500 fund from Vanguard, and it's exactly what it sounds like. It just follows the S&P 500 index, and you'll see that the standard deviation is the highest out of our 3 picks at about 15%. Now, this is only looking back at 3 years. So if we extended that further out, it could be closer to 17 or 18%, or it could be lower. Dividend yield is very low on this because the S&P 500 has been taken over by big tech companies. They don't pay dividends. It's just not really something we see. So you're not going to see very high dividend yields, but you will see really strong growth potential out of S&P 500 companies. So that just kind of puts us at a point where we're very well diversified, right? We've got a lot of different stocks. We've got a lot of different bonds. We're pretty good. Theoretically, all of the needs have been provided for. Like we have a cash position, we have sort of a moderate volatility position, and we have a growth position. Great. So if you're a DIY and you're hands off and you don't really like managing anything, you might just set it there and just kind of look away, and you might come back and rebalance every once in a while. But having more funds in the portfolio does give us more control. I like having that control. I like splitting allocations into multiple holdings so that I can have a lot of control over it. I like to be able to say, if I have, certain parts of my portfolio that have risen by a lot versus other parts have not come so much, I might be able to take gains from there, put it into my stage 1. It just gives me a little bit more. As the portfolio manager, me personally, I desire the freedom and mobility to rearrange our allocations as I see fit, whether it's for planning changes or if there's buying opportunities. If one of my pieces of the portfolio just really, really took a hit, like some of the technology today, I might, if I have extra funds to invest, I go, okay, well, maybe I'll buy the thing that's down. If you're in very few holdings, you don't really get the same sort of mobility in that. You just kind of have to buy into the whole pie, which is fine and totally works over time. But I like having a little bit more control. So we'll go to our next layer where we're at these 3 funds, SPSB, USMV, and VEU. So starting off, the first one is a short-term corporate bond ETF. It's got an expense ratio of 0.04. This was from SPDR. And it just, again, it follows an index. It follows a 1 to 3 year corporate bond index. So we're keeping that maturity short because in that stage 1, we don't want interest rate sensitivity. We don't want to see rates go up by a few percent and then our bond allocations just hit the floor. That's what we see when we look at 10 to 20 year bond funds or 20 plus year bond funds. That's why they're still down 30%, 40%, is because when those interest rates started rising up, their prices got crushed. So when it comes to stage 1, I don't want to have that vulnerability. I want to keep duration short, and you can see that the effective duration here is about 1.84. Standard deviation, again, is really low. It's not quite as low as the treasury bills, but still a 2% standard deviation. If I'm expecting it to return 4.75, maybe 5%, meaning it could go up by 7 or up by 3 in most scenarios, that's a pretty conservative fund that I'm okay having in stage one. Again, decent dividend yield, but because they're shorter term bonds, as rates fall, it might take a little bit longer than the treasury bills because we got 1 to 3 years, but they will still fall along with that. So just keep that in mind. Next, we have what's called a minimal volatility factor ETF. So remember, we were talking about sort of those passively managed factor funds, or I forget what the other word was, but this is a fund from iShares. It looks at the USA stock market index, and it follows the MSCI USA minimum volatility index. So it's still an index fund, still nice and cheap at 0.15%, but it gives us a standard deviation a little decently lower than that S&P 500 fund. Remember, that was closer to 15%. So we're able to shave off a little bit of that volatility by following this index that attempts to pick the stocks where they think are going to have the least amount of volatility based on some factors or analysis that they do. Now, again, the yield isn't super high, but it's higher than an S&P. Stocks don't usually have a yield that super high, but 1.6% is roughly okay. But again, it gives us sort of that moderate volatility where we're not going to be experiencing quite the same fluctuations as the S&P, as the NASDAQ, but we are still participating in that sort of long-term growth. So the next one that we have in stage 3 is a Vanguard fund that includes pretty much stocks from everywhere in the world except for the United States. So we had our United States stock index as the first fund in stage 3, but then on top of that, we're going to add a little bit of this international fund. So it's again an index fund, keeps it really low cost, 0.04%. Notice that even in layer 2, I still like to use low cost funds, especially for something like this that's still an index fund. Standard deviation is pretty close to the S&P 500, so that's why we're keeping it in stage 3. High volatility, we want more time. And the dividend yield is actually quite stronger than any of the US funds that we've looked at. That's kind of a common theme when it comes to internationals. Over the long term, they sort of have lagged the US, at least in recent times. But if you remember earlier this year, they quite outperformed by a decent amount, especially when the tariff worries hit United States investors. This sort of carried us. And I was very happy to have some allocations to internationals in my client accounts because it helped sort of buffer our volatility a little bit by seeing the US stocks go down, but having the internationals carry them by a little bit. So again, keeping it low cost, but getting that nice diversified exposure. It's going to have a lot of different stocks in there. Yes.
This is a question from Zoom. Can you say again, what does yield exactly mean? Like the 2.67 seems low. Like, can you say more about that?
So what yield is referring to, yield is essentially like what is the relationship of the income that you're receiving to the current price. So if I'm talking about an interest rate on a bond, I might have a bond that's paying a 5% interest rate, but the price is higher than that. So the interest rate that it's paying, the $50 on every 1,000, that might be 3% of the current price. So the current price really affects the relationship of the yield. So if you bought a stock when it was paying a 5% dividend yield and it's paying the same dividend, but the stock has just gotten way more popular, the price may have risen by a lot, it's paying the same dividend, but now suddenly it looks like a 2.5% because it's doubled in value. So it's really just kind of the relationship of the income payments to the actual price of the security that we're looking at. So we've now added a new layer of diversification. So what are the benefits that we've received so far? Well, the first is we got some diversification in our short-term bonds by adding a little bit of corporate debt. We now are not just in government bonds, but we have some corporate bonds as well. So there's a little bit of diversification there. So even if there's some uncertainty about the corporate sector, the government bonds may hold, or the other way around. We got some additional equity exposure with less overall volatility than the broad market by using our factor fund. So we were able to sort of tilt our way towards those less volatile stocks. So we still have broad market exposure through the S&P, but we sort of tilted our way away from some of the more growth stocks by increasing our allocation to the less volatile stocks. We also included a potential for non-correlated returns by using securities outside of the US. So again, sort of for those times like earlier this year when US stocks dropped by a lot, but the internationals held us. It's not necessarily that we're expecting the internationals to perform just like the US and give us the same amount of performance, but it gives us an opportunity to where if there's concerns that only impact the United States, then the internationals may not get hurt so much. And it just gives us another opportunity for drops that aren't so strong. So again, we could stop right here, and some people might. Again, it's a good portfolio. You've got a lot of diversification. It's good. But we're going to add one more layer of securities. So on the final layer, we're going to add 3 funds, and you'll notice some similarities between them based on what we talked about. So we've got LDUR, JEPI, and TGRW. So you'll notice that all of these are going to be actively managed funds. So we're finally stepping into that place where I'm okay to start paying a little bit of extra money to hopefully get some better performance or maybe just some better downside protection, whatever the case may be. So here is PIMCO's Enhanced Low Duration Active ETF. You'll notice that our expense ratio jumps up for the first time in a while, 0.5%. It's getting a little bit higher, but at the same time, there's a lot of funds out there that are charging 0.8, 0.9, maybe even 1%. So in the grand scheme of things, it's not the most expensive thing in the world, but we are paying a little bit extra. So what they're attempting to do is to get as much total return as possible. So that's talking about appreciation as well as income payments, but that's going to be consistent with preservation of capital and prudent investment management. So they're trying to make sure that the value of the investments holds itself as much as possible. They're not trying to take on tons of extra risk because they don't want to see the value drop by a lot. You can see that standard deviation is still nice and low for the last 3 years, about 1.8%. And the effective duration is also low at 1.655 years. Now that dividend yield is nice and strong at 4.7%. Maybe it's because they took a little bit higher risk with lower credit quality. But they are attempting to make this dividend yield nice and strong as much as they can so that total returns are strong without having a ton of extra downside risk. Next is JP Morgan's Equity Premium Income ETF. I believe we looked at this previously. They charge 0.35%, so a little bit over a third of 1%. But what they're expecting to do is they basically just buy a decent amount of stocks and then they'll sell call options on that to generate income. Now, the risk profile of that gets a little bit interesting because you're capping some of your upside return in order to get that income. And you can see that the standard deviation on this is something like about 10% for the last 3 years. But the dividend yield is all the way up at 8.5%. Now that's pretty high, but at the same time, if you were to look at its total return in comparison to something like the S&P 500, the S&P 500 would have, kind of gone way past it because though it's got a really strong dividend yield, that it's because they're capping themselves on the upside performance of the stocks inside. That's where that yield comes from. So it's like you're not getting tons of income just for nothing. It's not just coming out of thin air. It's coming from somewhere, and it's coming from capping the upside potential of the stocks inside of the fund. Now, lastly, in our stage 3, we've got a fund from T. Rowe Price. It's their growth stock ETF. So this is, in that category where 9 out of 10 underperform. Remember that. They charge an expense ratio of about 0.5%, and they seek to provide long-term capital growth. They seek investments in stocks generally of large capitalization, so big companies, think like S&P 500 for the most part. And they're looking for companies with strong cash flow and an above average rate of earnings or earnings growth. So the ability to sustain earnings momentum during economic downturns and all that fun stuff. So if that sort of strategy sounds like something that you want to participate in, maybe something like this is what you take a look at. Now, you'll see standard deviation is the highest out of anything we've had so far. So over the last 3 years, it's had a 19.5% standard deviation. That's pretty high. A 20% standard deviation, meaning that if you expect to return 10% for the year, 2 out of every 3 scenarios, it could be up by 30% or down by 10%, right? So there's a lot of sort of range that we could have. And we've got a dividend yield of 0%. Because for the most part, stocks that are growing in their sector, that are taking up a lot of more market share, they're not usually paying out income to investors. They're usually reinvesting all of their earnings back into growth. So you're just not going to see dividends with stocks like that.
Why do you do that?
Why would you do what?
Put it in for long term to get 0.
Well, the dividend yield, that's just income. So the idea is that the return comes from the appreciation, so that the stocks increase in value. So it's kind of like Nvidia hasn't really, I don't think they've ever paid a dividend, but they're still like one of the most valuable companies on the planet just because of what they do and like where they are. So that's kind of this type of company that they're looking at. So just because a company is paying income doesn't necessarily mean that their return is going to be the highest. So it's just kind of like balancing between those two. Because oftentimes, if you chase yield, if you chase high dividends, a lot of those companies are just paying out so much of their earnings that they may not grow that much in the future, versus maybe companies that are reinvesting all of it have a greater growth potential because they're not keeping that income to pay out to investors, but they're rather putting it back in. So maybe their company grows and maybe that stock becomes more valuable. So now we've completed our super simple little sample portfolio. So keep in mind that this is, again, a simple sample. This is not something that was built for somebody. This isn't one of my client portfolios that I'm showing you. This is just a demonstration of how we're arriving to holdings in each position. So if your needs are more complex or your assets are substantial, like if we're talking about $1 million, $2 million, or a lot of money, you should probably have more diversification and maybe even more stages of lateral integration. You can adjust everything that you see. The sort of 3 stages, it just makes it easy to understand: short-term, intermediate, and long-term. But some people like to, do different buckets for every year, or maybe they like to have 5 or 10 different allocation buckets. It really just depends on what makes sense to you. So this allocation is based on a balanced investor. So you might be more aggressive or less aggressive. And these securities are not specific recommendations. While some of them might be used in portfolios, it's not because all of these are just the best things and you should choose them forever. Some of them are good for their uses, but you have to understand the characteristics of each specific investment and really get why you're going to be buying into it. So your goal is to use the information presented to help understand the characteristics of the different products and how to evaluate them. Again, the only reason that I picked all of those is because they well represented the ideas that I'm talking about for each stage. So keep that in mind when you look towards building your allocations. So one of our next things, you know what? Let's take our break a few minutes early, and then when we come back, we'll talk about position sizing and we'll look a little bit deeper into the portfolio. So we'll come back in a few minutes. Maybe it's going to roughly get you into a balanced portfolio-ish. The more specific and less diversified and more expensive a position is, the smaller we want it to be generally. Now, I've talked about this before, but I make exceptions for bond funds a lot of the time when it comes to price, because there is actually some extra return that can be generated in the bond market. So that's a little bit of a caveat, but for generally, low cost is what we're after. So here's just sort of a basic guideline. So if you just picked funds that were similar to what we talked about today, and you invested them sort of in this sort of direction, so 40% of the portfolio was in stage 1, 40% of it was in stage 2, and 20% of it was in stage 3, and then same thing respectively for the different layers, this would give you a low-cost portfolio because it would bias heavily towards those first and second layer investments. Remember, both of these were pretty low cost, right? Layer 1, we were not even paying over 10 basis points or 0.1%. And layer 2, we were keeping sort of in that range. I would say, if I was going to put numbers on it, I don't really want to pay anything more than 0.15% for the first layer. I don't want to pay much more than 0.3% on the second, and then, anything above that, layer three. So like 0.5%, 0.8%, all that. I want to keep up here unless it really makes sense to keep it in another section because of, a fixed income fund or something like that. So this is a good just sort of basic guideline that will get you there if you just kind of follow it. And it looks like this within a $100,000 portfolio. So if we actually break it apart and see it in each different stage, right? We've got 40,000 bucks in stage one, 40,000 in stage two, and 20 in stage three. And then for our base of stage one and stage two, because these are the same size, they'll be the same numbers, 18,000 at the bottom, then 16, then 6. We just get that nice, really strong bias towards those low cost investments. So again, that just kind of shows here with those holding sizes. Now, what I want to do is I'm going to bring up this portfolio in my software. So this is what I use. This is called Y charts, and it gives me a really nice in-depth look at the portfolio that I'm looking at. So you can see that if I go to the holdings here, you'll see the same things that we talked about. SGOV, which has our treasury bonds in it, our Vanguard Balance Fund, our short-term corporate bond fund, our minimal volatility factor ETF, the S&P 500 fund, the international fund, and all the active funds that we talked about. Now, I'm actually kind of curious. If we were to look at this actively managed stock fund, yeah, see, again, here's the thing. I talked about that 9 out of 10 number where 9 out of 10 actively managed large cap funds are going to underperform the S&P. Well, there you go. That's like 75% of the return from one of the biggest and best, fund managers that exists out there, still on their active stock strategy. I mean, look at this downturn, right, in the 2022 to 2023 area. That was a really strong drawdown that even the S&P didn't experience. And so you can see a max drawdown on a fund like this was 43%. Now I'm curious how long this has existed. Yeah, it's existed since 2020. And even just since then, it had a drawdown of 43%, which is really strong. And again, you're paying that 0.5% for that. So that's kind of, again, why I'd like to bias towards those low cost investments, because if I'm paying 0.5% and you're still underperforming by a significant margin, like why am I paying for something like that? But if we go back and we look here, you can see this number called net expense ratio down here. That applies to both individual funds and to portfolios. A net expense ratio is pretty much just going to be, what is the fund charging me? Like, what is the management cost of the fund? And then there might be some little bits of like fund fee rebates or little things that adjust it down. So the net expense ratio is, at the end of the day, how much am I paying for the investment strategy that I'm in? And then for a portfolio, we're really just taking the fees of all of the funds and we're averaging them together. Now you can see that we have a really nice, really low net expense ratio of 0.13%. So that means I'm not even paying 1/5 of 1% per year for the management strategies within this portfolio. And it does a pretty good job of what it does. Yes.
You're pulling up these graphs, which chart the graphs.
Uh-huh.
Two lines, is the top line S&P or something, or?
Yeah, so this orange line here is the S&P 500. That's how that's returned over the same time period. So this is over 3 years. You'll see a pretty big differential, mostly just because we're taking on less risk. Just because we've got bond allocations, we've got treasury bills, we're just not taking the same level of risk. But at the same time, the benefit of that is where you see this really strong fall in the S&P 500, we remain relatively stable in comparison. So again, nice low net expense ratio, and now nice low effective duration as well, because as I mentioned before, that interest rate risk can be pretty substantial. In fact, let me demonstrate this with something real. So if I'm going to go to my dashboard and I'm going to grab two funds. I'm going to grab the 10 to 20-year Treasury bond ETF, and then I'm going to grab the 20-year plus ETF. So here's the 10 to 20-year. Now it had some times where it did really great. When interest rates dropped really far, the value of this fund went flying because obviously super long bonds with locked in high interest rates and then rates fall really far. 10 to 20-year bonds, a much higher interest rate, 5% compared to 1, that sounded pretty great. But at the same time, if we look at a 5-year period where the interest rates came back up and pushed the price of this bond fund down, the return of this over the last 5 years has been negative 26%. The return of this, that's not the price change. That's not just how much you buy the fund for. That's including all of the 4.5% interest that gets paid out as well. So that's including that into the return numbers. If I change it just to price, let's see. Yeah, it's gone down from, let's see, you bought it for $164, now you buy it for $104. But this is one of those reasons why it's important to keep that duration under control, especially when you're in an instance where interest rates are low. Yes.
Okay, so now on this particular chart, you've got 2 lines, the purple. So
Yeah.
this one, that's not the S&P 500 now,
Yeah.
is it?
So this is going to be an aggregate bond index, which is
Okay.
basically just looking at.
So we kind of need to
all the
label
bonds.
these so we know what we're talking about here for us. And
Yeah,
because you know,
yeah. So you
I
could
just see this graph and I don't
Yeah.
know what you're talking.
Yeah, so you'll see the fund will be labeled here as the
Yeah. Okay. So I get
10 to
that the
20.
one line is the fund, but I don't know what that other line is.
Yeah, so this will just be what's called the Bloomberg US
There it is.
aggregate, which basically is just saying we're just looking at all of the bonds on the market and we're putting them all into one index, just comparing against that. So you'll see here again, sort of that max drawdown is really high, 41%, which is basically what that is. Basically just means what is the furthest down it's gone off of its high. So like if we're looking at yeah, the lowest of lows, like just how far down did it go? And that was about 41%. Yeah. Yes.
Correctly, you said that the yellow, the orange.
Yes.
The orange is an amalgamation of all the bonds
Yes.
out there compared with the specific one that we're
Yeah,
looking
compared with this fund, which this fund specifically invests in bonds of 10 to 20 years.
So why is there probably is a good reason why comparing all that is out there
Right.
versus this one?
Yeah, so pretty much the reason why we compare it like that is just because this is going to be like your sort of cheapest exposure. It's just, this is what that category of investments does. So if we're just comparing super long-term bonds to bonds, now, while we're doing this, because this is an index fund, it's just sort of taking that giant index of all the bonds and it's just chopping it into a smaller piece. So if I was looking at like an actively managed bond fund like this, I might compare it to specifically, if it was actively managed 10 to 20 years, I might compare it only against 10 to 20 year, like an index. But because this is an index fund, we're just going to compare it to the overall index. Now that's with 10 to 20 years. If we look at the 20 plus years, the number is now negative 35%. So again, it's because of that really long, what's called effective duration, which is essentially just taking the maturity length of the bonds, how long until the bonds will pay back their principal, plus factoring in the amount of interest that they receive on a regular basis. So while this is a nice low-cost fund, you know, you have a bit of risk. Now, in the current environment, you might look at it a little bit differently because rates are higher and where people expect them to be cut. So you might expect that this is going to recover in time, especially if rates get dropped. These funds tend to increase in value because they're longer in duration. The longer the duration is, the more the value of the fund or the bond changes in response to interest rates. So, yes.
But for people who are in their mid to late 60s or mid 70s, would a 20-year, would something like that even be appropriate?
Well, yes, it could be, because it's not necessarily that you have to wait 20 years before you can ever get your money back with a fund like this. If you were buying an individual bond, if you were buying a 20-year bond, maybe not, because it's going to be locked up for that period of time. But because these funds are still liquid and you can get in and out of them, these are used a lot of the times for balanced portfolios, especially. It's just Really, the only difference is going to be the length of the bonds inside them. So you can still trade in and out of them easily because it's wrapped up in an ETF. But it really just kind of depends on the environment that you're looking at. So now, if we're expecting rates to drop more, I might be more comfortable investing in something like this, because if rates are really low and the only place they have to go is up, then I'm not going to consider this, because this is obviously what could happen. But if you're in a bit more reasonable of an environment where interest rates aren't sitting at 1% or lower, then it might be a little bit more reasonable. But for the most part, kind of aligning with, it's not really, I like to go for the lower maturity bonds just because it's a lot less risk. And especially, over the last while, they've been paying similar interest rates. I mean, even just kind of that fund that we looked at, SGOV, like it's paid this 4 to 4.5% for a long time. I mean, the interest rate on these has been the same as the longer term bonds for a long time. So it really kind of depends on the environment that you're looking at.
So the number, when it says 0 to 3 or 20-year plus,
Yes.
it doesn't mean you've got to hang on to the bitter end.
Right.
Because you're locked into that. Okay.
Right. Yeah. So that would be true only if you were buying the individual bonds. But at the same time, you can still sell bonds. It's just a little bit more difficult, not as much liquidity. But okay, where did we go? Here we go. But yeah, we keep relatively low duration because, again, that sort of, especially when interest rates are low, that really helped us a lot when we were looking at portfolios, because we just like to balance, we just like to lean towards the shorter duration bond funds. So when interest rates went flying right back up and all the bond values got crushed, those shorter term bonds, the treasury bills, the short term corporates, they didn't get hit nearly as hard because they didn't have that same sort of reinvestment rate risk that the longer term bonds did. You can see that we have an annualized standard deviation, which is basically just looking at all of the returns that we have, remember, and giving us sort of a channel in which we can expect a decent amount of our returns to be in. So this just is really a way to say volatility. So seeing it go up 7 or down 7 from its expected return, 7% is a nice moderate area. Somewhere between 7 to 9% generally is going to be in that balanced range, where you also have a beta. And remember, this is relative risk. So we're comparing it to the S&P of about 0.46. So you could say we have roughly half the volatility of the S&P 500. And you can see that pretty much in our chart here, especially if year to date is a chart that I often look at, especially since what happened in April. You can see that while the S&P took a really strong dive, about 15%, we did not drop nearly as much in this sample portfolio. We would have been down about, let's say it says 4.6%, right? So that defensive sort of allocations to stage 1 and stage 2 really helped moderate the volatility on that. I don't know what happened here. Let me just get back to, there we go. But we also have to understand that if we're going to do that, if we're going to pull back from the volatility, that means that we also pull back from the returns, right? So while the S&P continues to go and go and go and go, while our returns do remain more stable, it also means that we give up some of that appreciation. So balancing between those two things is really important. You can see we've got a dividend yield of 3.24%, mostly because of a lot of those short-term bonds giving us extra income. Yes.
Is this the example? Is this example the purple line, the one that you just built?
Yes.
The scenario
Yeah.
you just built?
Yeah.
Okay. So
Yeah. So this is the portfolio that we just put together. And you can see that if let's see, I can pull the allocation section up. You can see that we have a decent amount. In fact, this actually has a little bit less in the stock than a 60-40. It's closer to a 50-50 portfolio with about 52% in those stocks and roughly another 50% in your bonds and sort of cash. Now, this analysis software talks about cash a little bit more generously. It'll use like 2 or 3 year bonds as cash. I prefer look at 1 year or less bonds as my cash equivalent, but so that's just something to keep in mind here. But you can see we have really strong diversification. I mean, we have a lot in the developed markets because that's just kind of what have been the biggest stocks. Those are the highest values are in those developed markets, but we might add a little bit of emerging markets if we are concerned about that. You can see we've got decent diversification when it comes to company size. So you see we have a decent amount in the giant companies, which is interesting. This didn't used to be a category. There wasn't always a giant market cap section. We would just say large cap. But companies have gotten so huge, Nvidia and Apple, they've gotten so massive that they made a whole new category just for those giant companies because the valuations, it would just be like 60% in large cap when now you can say that there's this extra bit. We've also got 23% in our mid caps, but only 1% in our small caps. So if you believe in small companies, you might add a little bit of small cap exposure. We've also got a decent amount of split between government bonds, about 52%, and corporate bonds at about 40%. And then this thing here called securitized, which is pretty much, you can think of that like a mortgage being turned into an investment product or something like that, where it takes some sort of loan and then turns it into an investment product, but it's not a bond. Kind of the same thing, but not quite. About 2% in cash, which I think, I don't know how they're calculating that, but that's not really important right now. You can also see that we've got here, we can see the difference between the stock styles. So you've got large cap value, which basically just means bigger companies, lower fundamental numbers like price to earnings or price to book. So if you like reading financial statements and you're into that sort of thing, you might be more of a value investor. Blend, which basically just takes growth and value and blends them together as it sounds. You've got your large cap growth at about 17%. Mid cap blend is our highest in the mid caps, it looks like, and then very small allocations to small caps. And then you can see over here, we've got really strong bias towards high credit quality for these bonds. So the higher you are on this letter scale, the higher chance there is, or the sort of higher credit rating of whoever is selling you the bond is. So when we're talking about government bonds, they're pretty much always going to be rated AAA, whether you agree with that or not. That's just kind of what the standard is. Government bonds are considered guaranteed in a way. And then even if we dive into corporate bonds, I still want to be looking at high quality. Maybe I'll introduce some of the lower quality bonds for some extra interest yield, but I don't want to go all the way down into the not rated and triple C's, double C's. Like I don't want to get too mixed in with super low credit quality. Here are some other interesting things. This stock sector exposure, so you can see this is going to be really common. Pretty much most portfolios are going to have really strong technology exposure. That's just due to how big these tech companies have gotten. So if you see this, if you look at a portfolio like your own on something like Morningstar and you see that, know that that's pretty common. That's going to happen. That's actually very similar to what the exposure is in something like the S&P 500. In fact, I'll just show you that if we go there, oops, not that one, allocations. If we look at the S&P 500, we're going to see a very similar story right here on the right, but even to a stronger extent. Technology makes up about 35% of the S&P, just because those companies have become so large. And I mean, we could predict immediately what we're going to see at the top, but just for demonstration purposes, you see Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Tesla, it's tech companies from the top down. So that's, Nvidia is almost 8% of the S&P. It's almost 8% of the total allocation to the S&P 500. Well, it's not tech necessarily. That's just one of the holdings in the S&P 500. These aren't all tech companies. They're just, that was part of those. Yeah. But yeah, so a lot of technology companies in here. I mean, you see Netflix and Oracle and Palantir and all of these different tech companies. So it's not surprising when even if we're well diversified, we have a strong allocation to technology. And that's part of what's called a sensitive sector. So sensitive sectors are much more likely to have strong fluctuations during market turmoil, especially like right now. I mean, we saw the sectors that were hit the most were consumer discretionary, so things that people spend money on when they have extra money. Technology also got hit because of the concern of their underlying hardware being subject to Chinese tariffs. And things like consumer defensive and consumer staples, things that people spend money on sort of regardless, groceries and food products, those still carried strong because there's not the same sort of concern. Oops. And so you can also see in the bond maturity exposure here, we've got in short term, they talk about 365 days and less. We've got about 46% allocated there. Main reason for that is because of how much we put into stage one. We're keeping a lot of those assets into super short-term treasuries or corporate bonds that aren't going to fluctuate a lot towards interest rates. You see we've got about 45% of it in intermediate, which most of that's in the 1 to 3 year. So that's our 1 to 3 year corporate bond we were looking at. And then not very much in the long term. The one fund that does have the long-term bonds, that would have been the Vanguard Balance Fund that we looked at because they used an index fund for their bond holdings. So they're going to have some of those long-term bonds. Now, just quickly before we talk a little bit more about the portfolio that we built, I just want to show off Morningstar. This is kind of what you could expect if you were to get Morningstar via paying for it directly or using a library card like we suggest to get it less expensive. You can look at some of the same things here as I look at in my software. So you can see we've got the Vanguard S&P 500 fund on both services here. So you can see it'll show you some of the similar things like adjusted expense ratio, which is the same thing pretty much as net expense ratio. You can see what kind of stuff it invests in. So you can see the category is US fund, large blend, which essentially just means it's United States stocks, big companies, and it's a blend of growth and value because that's pretty much what the S&P 500 is. There's some extra stuff that you could see on here like the total assets in the fund, $1.4 trillion in this one S&P 500 fund, pretty strong. And so here's some of the stuff that you could see if you paid for Morningstar, you would get Morningstar's analysis. So you can see things like the medalist ratings, which is more of their opinion. And then you can see the star ratings, which this is really just looking at its historical performance. So if a fund has just had to have a really good year, it's going to have higher stars versus if it had a bad year, if its sector didn't do so well, it's going to have a lower star rating just because that's purely performance based. It's basically algorithmic at this point. You can see some of the similar things like when I go to allocations in here, portfolio is where you're going to see the similar things in Morningstar. So you can see here how much of it's in US equity or non-US. I didn't know that the S&P 500 had a little bit of non-US. That's interesting. But you can see a lot of similar things. Here's some of the sort of fundamental stuff that you could look at. Same categories like those defensive, sensitive, and cyclical. So a lot of these things are common between a lot of the different sort of analysis tools. So a lot of the things that I talk about, you should be able to find, whether it's here on Morningstar, if your broker-dealer gives you a solution or your investment advisor gives you something, or even if you use like Yahoo Finance. You should be able to find a decent amount of the similar things. Same thing, you can see all the holdings here if you want to. You can go through this whole list and see the same companies here. Same sort of stuff. They have a sustainability page, which is nice. So if you care about sort of values-based things, like if you don't want to invest in companies with high carbon exposure or sovereign sustainability, corporate sustainability. They even just give you a nice score up on the top left, like how many globes. So you can see, so they're basically just looking at how is the holdings managing their environmental, social, and governance concerns and risks relative to the global category peer group. So it's not just a raw measure of how sustainable and nice they are, it's compared to other investments like it. So keep that in mind when you're looking at it. It may not be just exactly how sustainable it is, but how sustainable it is compared to its peers. Let's see, we can see some of the similar stuff that I talk about in the risk category. One thing they also include is a portfolio risk score. So if you just want one number to look at and give you a relatively decent idea of how risky something is, these sorts of numbers can be helpful. You can see it puts it into the aggressive category. You can see how each number sort of relates. And then you'll see risk versus category and return versus category. These are nice, and the only reason that this has above average returns versus the category is because that category 9 out of 10 times underperforms this investment. So remember, this is the cheap index fund compared to anything managed that tends to underperform. So that's kind of a little bit of an example of what you could expect to see in Morningstar, and we can get a little bit into that more after we finish our last couple slides. But what I want to talk about before we end is what could we have done to improve the portfolio that we're looking at, right? So we built a portfolio. It was pretty good, but we could do more if we wanted to. We could add other things. We could have further diversified the income holdings, right? So we could have added some longer term government bonds if we wanted to. We could have added some high yield corporate bonds if we wanted to, get some more dividend yield. We could have added managed bond funds or really anything, international bond funds, all sorts of different things. We could add more sector specific and non-correlated investments in our stage 2. So we could have added some more cyclical sector funds. Things like utilities tend to be a little bit more defensive. Consumer staples tend to be more defensive because they're things that people are going to buy regardless. So we could have just diversified a little bit more. And you remember we were looking at sort of the size of the stock investments too. Our small caps, we had basically nothing in there. We could have added a little bit of small caps in our stage 3 by adding maybe a small cap value fund or a small cap blend or whatever sounds good to you. But we really could have diversified a little bit further with more holdings. But the things to remember, each portfolio is going to take on a different form based on its purpose, right? So like my portfolio is going to look a lot different than yours, which is going to look a lot different than somebody else's. Like everybody sitting next to each other might have some similarities, but some of you might have deeper concerns. Some of you might be more concerned about ESG values. Some of you might be more concerned about cost. Some of you might be more concerned about taxes. How are the taxes going to affect you? Something we'll talk about deeper later. It's like what the portfolio performance might have an implication on your tax return at the end of the year. So it's understanding how all of that works together. But regardless of how many funds you have, you can make your portfolio as simple or complex as you want to. You could have it be one fund. Target allocation fund, fine, if that's what you want. If you want to do 3 funds, great. 5, 10, 15, whatever. Doesn't matter. What you want to make sure you have is diversification. So if you buy one fund that's really well diversified inside of it. If you buy 3 funds, make sure that those 3 funds keep you well diversified. If you want to buy one fund for each sector in the S&P, you could do that. Just make sure that you're not too concentrated in any one sector for any of the reasons that we've talked about before. Make sure you bias your holdings towards low-cost investments. Fees are oftentimes, pretty much, like most of the time, they're the #1 detractor of returns. Fees, pretty much every time. If you're going to pay for something, just understand what you are paying for. And if you're paying for performance and not getting it, maybe stop paying for the performance, right? So fees can be a major detriment to performance, even with good performing funds. There are funds that are good, they perform well, but they still don't match their index. Managed growth funds, again, like 9 out of 10 times, they fail to outperform the S&P. So you could pay somebody 1% to try and beat the S&P, but if 90% of the time they're going to fail to do that, and your returns are going to be diminished by the amount you're paying them for it, why would we do that, right? So it's just making sure that we use those low-cost investments to bias towards things that just are super well diversified, reduce our unsystematic risks that are attributable to each individual company, and making sure that we manage our risk with how much we allocate to each stage, how much time we have, how much income needs. Those are the most important things to think about. The investments, you're probably going to get a little bit less return than the market because you're probably going to take on less risk. So that's fine. So just use those low cost funds and build yourself a nice efficient portfolio that doesn't try to do too much, that accomplishes your goals in a reasonable price. So with that, got any questions or comments just on the portfolio building process, period, individual holdings analysis? Is there anything anybody wants to talk about? Yes.
When you do people's portfolios that they had somewhere else, what are some of the problems that you have found? So
Yeah, so the question is, when I've looked at other portfolios, like if I evaluate somebody who's come in and they want to have me look at their portfolio, or somebody who's transferred an account in, what I see for the most part, number one is going to be fees, pretty much every time. Number one, the worst thing is the fees. It's either the fees or the fact that the investor just doesn't really understand what they're invested in, period, right? They just got put into a portfolio. They don't really get it. They just close their eyes and they think it's done okay. But most of the time, it's going to be those high fees. There are companies that tend to have much higher fees, like American funds and Capital Group tend to have much higher expense ratios. In some categories, like fixed income, bond portfolios, it might pay off a little bit, but they have good funds that invest in good companies, but their stock funds still, they just don't outperform. Then you're going to pay for that fee. A lot of the times you can look at you can compare actively managed stock funds versus a stock index. And a lot of the times the managed stock fund will underperform by a little bit. And then if you add the fee back, it's like basically the same as the index, right? So that's normally sort of the number one thing, or it's not well designed for their tax scenario. So when it comes to taxable accounts like trust accounts, individual accounts, if you've got these stock mutual funds that actually pay out their capital gains in the form of distributions, somebody might be getting these big tax bills at the end of the year and they don't really understand why. They're like, I didn't get any more money in my bank account. I don't feel any richer. I know my portfolio did okay, but they're getting these distributions that are taxable within the year that they hit the account. And some people are just not aware of the implications of that. So it's really mostly cost, taxes, and then just understanding the portfolio, period. Those are like the main problems that I see for the most part.
do you find that the big companies individually create portfolios for the client, or are they in one big model?
No, for the most part, in fact, a very large percentage of advisors or people who are, helping you plan with your money and investing your money, they're either putting you in a model portfolio that their brokerage firm decided on, that their investment advisory firm decided on, that this is what you invest in, or they're shopping it off to what's called a separate account manager, which is basically somebody they pay a marginal fee to, or actually you pay the fee to. You pay an extra little bit of a fee for them to manage the portfolio for you, and then they charge their 1% on top of that. So oftentimes, no. Investment advisors and stuff are not often creating individualized portfolios. Sometimes that can be okay if the advisor really understands the product and understands how it fits for you. It's all about if it actually fits. If they're just taking a risk box and then they toss you in there and then they have no idea what's going on, I don't know if that person is really connecting all the dots for me when it comes from my investments to my needs. So oftentimes, no. It's usually model portfolios and separate account managers. And those separate account managers, if it's a particular strategy, if it's something that is more tax efficient or some kind of bond portfolio that performs better, just like a managed fund, I might be willing to pay that fee, but I don't know. I like the low cost stuff more. Anything else? Yes. Sure.
To the other side, what
Yeah.
would the fund managers, the brokers say about people in the financial planning side of it, the fee-based as opposed to commission,
Well, I guess,
both positive and negative?
well, I'll start with the negatives because a lot of people will talk about sort of the structure of the fees. So if fees are charged continuously, annually, year over year, you're getting charged a percentage. Oftentimes, financial advisors like us will charge a percentage of the assets because what we're doing is we're basically just taking income off of that management. We're managing the assets, and then we're also doing consultations throughout. So some people may say that you should go fee only and you should only pay like a flat fee for the services that you're getting, which is fine. I'm okay with that. But at the same time, there are little reasons. This is just a fun little reason that I like to think about the percentage management fees. If you have something like a tax deferred account, like an IRA, if you're managing an IRA, there's two different ways that you could pay for it. You can either pay for it out of pocket, pay for it with a credit card or a check or whatever you might want, or you pay for it with dollars out of the account. Those sound the same. They sound like they'd be economically the same, but there's a little tiny tax advantage for paying for it out of the retirement account because you don't have to distribute the money, pay taxes on it, and then pay the bill. That's just a fun little thing. But negatively, they would usually talk about the fee structures, especially for people who tend to put you in like a model portfolio or a separate account manager and then just not really interact with you. So if there's low interaction from the advisor, then they're just like charging this big fat fee annually, year over year, not doing anything. So if they're not doing anything, then obviously those fees stack up and they come out of the returns. Now, if there's value getting out of that, it's great, especially if there's a lot of consultation and a lot of planning. That value might end up flipping on the other side. So it kind of just depends on the situation. But yeah, I mean, I haven't really run into many, I'll be honest with you, I haven't run into brokers very often, like in practice at all, especially these days. It's just commission-based stuff. I just don't really see it anywhere except for insurance. That's where I see that sort of style still exists. So I've personally never interacted with a stockbroker ever in my life. And so yeah, I just don't have much about that. Anything else? All right, well, we'll be here for a little bit afterwards, but that brings us to our time. So thank you all for coming in. I hope that this was helpful for looking at your portfolios. And if you ever want me to take a look at what you've got, I'm always happy to just look at the portfolio and give you a rundown. No commitments, no nothing. We're not trying to solicit or anything, but if you ever want me to look.